I know what it's like when a shop talks about an insurer, so I'll make this fast. State Farm is giving customers $100 back this summer. They've also cut what they'll reimburse you on a collision repair by $10 an hour in this market, and on a real repair, that gap alone can cost you more than the check is worth. But the labor rate is actually the smallest part of what we need to talk about today, because beyond the rate cut, there are repair procedures your vehicle may legitimately need, procedures that exist specifically to keep you safe, that insurers are increasingly pushing back on covering, and parts questions, and a claims process that has gotten significantly less transparent about how decisions get made and who's making them. One of these facts got a press release. The rest got silence, and that is what we're going to talk about today. Hey everybody, welcome back. I'm Eric Raymer, and this is the Airing of Grievances, brought to you by Nyland's Collision Center, where we believe you deserve to know what's actually happening inside the insurance industry that affects your car, your wallet, and the value of the policy that you're paying for every month. Today we're talking about State Farm, and I want to be upfront with you from the jump. This is not a segment about shops complaining that they're not getting paid enough. I'm going to ask you to hold on to that thought, because the minute this starts to feel like whining, I want you to call me out. That's not what this is. This is about you. This is about what your premium is actually buying you. And this is about a practice that is quietly, without much fanfare, reducing the value of what you think you own when you think you have good insurance coverage. Let's set the stage. The headlines look great on purpose. A few weeks ago, State Farm made some very positive sounding announcements. They reported $12.9 billion in net income for 2025. That's more than double what they made in 2024, their best year in recent memory. And on top of that, they announced that they're paying out a $5 billion dividend, cash back, to their policyholders. That's an average of about $100 per vehicle. That's going to 49 million vehicles nationwide. Now, and this is important, State Farm is what's called a mutual company. That means they don't have outside shareholders. There's no Wall Street involved. The policyholders are technically the owners. So when they pay a dividend, they're paying it to their customers. That's the story they want you to hear. And honestly, on its face, it's a decent story. $100 back. Rates are being lowered in 40 states. The PR machine is running smooth. Good neighbor and all that. Here's what they're not putting in the press release. At the same time State Farm is cutting you a $100 check and lowering your premium, they have also, over the past 8 months, cut the labor reimbursement rate that they pay out on auto claims by as much as 20%, depending on where you live. Now, let me explain what that means in plain language, because the way this works is not intuitive, and I think a lot of people genuinely don't understand. When your car gets damaged and you file a claim, State Farm does not write a check directly to your body shop. That's not how it works. State Farm writes a check or issues a payment to you, the vehicle owner. You are the policyholder. You are the claimant. The shop submits an invoice to you, and the insurer reimburses you for what they've decided your repair is worth. So when State Farm sets a labor rate, what they're really saying is, this is the maximum that we are going to reimburse our policyholder per hour of labor on this repair. They're not telling the shop what to charge. They're telling you what they'll cover. Today, our rate at Nyland's is $70 an hour. That's what we charge. That reflects our technicians' skills, our equipment, our certifications, our facility, our commitment to doing repairs the right way, the safe way, on modern vehicles that are increasingly complex and require increasingly specialized knowledge and tools. A year ago, State Farm was reimbursing their customers $72 an hour for labor here in the Denver metro area. That's a reasonable number. We were actually close to whole on that. Today, State Farm is reimbursing their customers $62 an hour in this market. Let me say that one more time. 12 months ago, $72. Today, $62. That's a $10 per hour drop in what State Farm will give back to their policyholder for collision labor. Now, multiply that across a repair that involves 20, 30, 40 hours of labor, which is not unusual on a modern vehicle with advanced safety systems, and you start to see real numbers. We're talking hundreds of dollars coming out of someone's pocket that they had every reason to believe their policy was going to cover. Here's what makes this particularly hard to stomach. While State Farm is reducing what they'll reimburse you for repairs, every single cost associated with actually repairing your vehicle has gone up. Material cost, paint, adhesives, welding materials, replacement components, all up. Skilled labor costs more. Finding and keeping qualified technicians in this industry is harder and more expensive than it has ever been. These are professionals. They have to be certified. They have to be trained on new systems constantly. And the vehicles themselves are more complex than they've ever been. The car sitting in your driveway right now, if it's a 2019 or newer, almost certainly has a suite of driver assist technology. Cameras, radar sensors, ultrasonic sensors, lane keeping systems, automatic emergency braking, adaptive cruise control. All of that technology is integrated into your bumpers, your mirrors, your windshield, your doors. And when you have a collision, even a seemingly minor one, those systems have to be inspected, calibrated, verified. That's not optional. That's not an upsell. Those are the systems standing between you and a rear-end collision on I-25 at 65 miles an hour. If they're not working correctly after a repair, the consequences could be catastrophic. There's another piece of this that came out in the P&C Specialist article. That's an insurance industry trade publication put out by the Financial Times. They interviewed more than a dozen repair shops and reviewed internal documents and recordings. What they described was State Farm increasingly using centralized audit teams to review and override estimates written by their own adjusters in the field. Think about what that means. A State Farm adjuster, someone with actual knowledge of the claim, the vehicle, the damage, they write an estimate. Then a centralized team sitting remotely, possibly using software and AI-driven rule sets, reviews that estimate and kicks things back. Line items get cut. Operations get denied. And when shops or consumers ask for an explanation, the response comes back as something like, "The manager said." There's no name, no explanation, and no transparency. It's a black box. You submitted a claim, something happened inside the machine, a number came out the other end, and good luck understanding why. A repairer from our state who has been deeply involved in advocating for consumers on this issue described it this way. Instead of a regional representative you can actually reach and talk to, look in the eye, someone who understands the local market and the specific situation, everything is now routed through a remote call center, through AI filters, through rules strategies, and the explanations, when they come at all, are anonymous and unjustifiable. That's the claims process that you're paying for. And here's where the rubber meets the road, no pun intended. You get in an accident. You file a claim with State Farm. You want to bring your car to a shop that you trust. Maybe it's a shop that's certified to work on your specific make of vehicle, which matters more than most people realize. Your shop charges $70 an hour. State Farm says that they're going to reimburse you $62 an hour. That's an $8 gap, and now it's your problem. On a significant repair, that gap adds up. So you have a choice. Pay the difference out of pocket and go to the shop that you choose, or go to one of State Farm's preferred shops, what the industry calls a direct repair program shop or a DRP shop. Now, I'm not going to stand here and tell you that every DRP shop does bad work. That's not fair and is probably not accurate. But here's what I will tell you. We don't know what the deal is between State Farm and their network shops. The terms of those agreements are not public. It's entirely possible, and frankly, it's likely, that those shops are operating on negotiated rates that are even lower than $62 an hour. That's the whole point of a preferred network. The insurer gets volume commitments and cost controls. The shop gets referral traffic. And what does that mean for your repair? I don't know. And that's exactly the problem. You don't know either. And State Farm isn't volunteering that information. What I do know is that the person who ends up holding the bag in that scenario is you. Either you pay out of pocket to go somewhere you trust, or you go somewhere the insurer has a financial arrangement with and hope for the best. That is not what good neighbor looks like. That's what a squeeze looks like. I want to come back to the dividend for a second because I think it deserves some scrutiny in this context. State Farm is going to send you a check for roughly $100 this summer, and they're going to lower your premium by an average of about 10%. Those are real dollars, and I'm not going to pretend otherwise. But let's think about this together for a minute. They made $12.9 billion in profit last year. They're paying out $5 billion in dividends across 49 million vehicles, about $100 a car. And simultaneously, they've cut what they'll reimburse you per labor hour on a collision claim by $10. In this market, that's a drop from $72 to $62 over the past year. You're getting $100 back. On a repair with 30 hours of labor, you're potentially eating $300 in uncovered cost because of the reimbursement cut. And that's before we even get into the pressure against proper safety calibrations and inspections. The math isn't hard. Now, to be fair, most State Farm policyholders won't file a collision claim this year. For those people, the $100 is a pure win. Lower premiums, cash back, great, genuinely. But for the people who do have a claim, the people for whom the policy actually has to perform, what's happening on the reimbursement side of this equation is moving against them. And those people are not the ones State Farm is issuing press releases about. The P&C specialist article that started this whole conversation cited interviews with more than a dozen shops and a reveal of internal documents. Industry surveys showed that 57% of shops reported State Farm had reduced its labor rates without any explanation. Trade publications have been covering this trend for months. That's not one shop in one market having a bad experience. This is a deliberate, systematic shift in how State Farm is handling claims. Centralized audit teams, AI-driven reviews, rate reductions, pressure on safety procedures, all moving in the same direction, all at the same time. And here's the part that bothers me the most. It's happening quietly. There's no letter to policyholders saying, hey, we've adjusted our labor reimbursement rate in your market. Here's what that means for your out-of-pocket exposure if you have a claim. Nothing like that. You'll find out when you're standing in a shop after an accident, already stressed, already dealing with a disrupted life, and someone has to explain to you that your coverage has less buying power than it did a year ago. That's not transparency. That's opacity by design. You know what this reminds me of? You go to the grocery store. You buy the same box of cereal that you've always bought. The same brand, same box, same price. Actually, probably a little more than last year. You get it home, you open it up, and it's half full. The box says, contents may settle during shipping. That's called shrinkflation. Same package, same price, less product. It happens so gradually that most people don't notice until they really stop to think about it. And that's what's happening with your auto insurance. Same premium. In fact, State Farm's premiums went up substantially over the past few years, just like everyone else's. Now they're coming down a little and they're handing you $100. But what's inside the box, the actual coverage value, the labor reimbursement rate, the real-world buying power of your policy at the moment you actually need it, that is settling quietly while the box looks the same on the shelf. You're getting less for what you're paying for, and most people have no idea. So what do you do with this? Well, there are a few things. First, know your rights. In Colorado and in most states, you have the right to choose your own repair facility. Your insurer cannot legally require you to use a specific shop. If anyone tells you otherwise, that's not accurate. You have a choice. Second, ask questions before you have a claim. Call your agent. Ask them, what is State Farm's current labor reimbursement rate in my market for a collision claim? What does that mean for my out-of-pocket if my shop of choice charges more than that rate? Get it in writing if you can. You deserve to understand what you're buying. Third, if you're in a claim right now and you feel like you're being steered, pushed, or squeezed, get a second opinion. Talk to your shop. Ask them to walk you through the numbers. A good shop will take the time to help you understand exactly where the gap is and what your options are. And fourth, pay attention. This kind of thing continues because most consumers don't know what's happening. You're watching this, sharing this, asking your agent about it. That's the only real check on this behavior. Regulators move slowly. Legislators move slowly. Informed consumers move faster. Look, State Farm is not uniquely evil here. We're talking about them because that's who the articles are talking about. The Financial Times isn't a collision repair publication. There's someone on the outside talking about what's happening and how it affects consumers. Only after they published their article did the collision industry pick it up. This is an industry-wide trend that is increasingly anti-consumer. This is an industry under pressure, and pressure finds the path of least resistance. In this case, that path runs directly through your claim, through your repair, through the safety systems on your vehicle that you don't think about until they don't work. We're going to keep talking about this because the only thing that actually moves the needle on how insurers treat consumers is consumers who know what's happening and refuse to accept it quietly. So here's my one ask. Don't subscribe. Don't leave a comment. Just think of one person in your life who has State Farm or any other insurer that might quietly be reducing what they pay you. A family member, a neighbor, a friend, someone who has no idea this is going on. Send them this video before they have a claim, because after the accident is the worst possible time to learn that the policy that you've been paying for doesn't cover what you thought it did. And that's the whole point of what we do here. My name is Eric Raymer. This is the Airing of Grievances at Nyland's Collision Center. If you're in a claim right now and you don't know where to turn, give us a call. We'll help you understand your options, whether your repair is with us or not. That's not a sales pitch. It's just what we do. Thanks for watching. We'll see you next week.